So traders, now that we know what imbalance is, we're going to do some application to the chart. Now, obviously we can see that we've had this impulsive movement already, and it's broken out through multiple points of structure. So we're going to mark out some structure points. We can see that this was clearly a swing low. This was a swing high, guys. Obviously, we will cover this in a future lesson, but there is liquidity built up by here, and the momentum is bullish because it actually broke out of this swing high by here. So we're actually going to wait for a break, but we can actually see that the structure has already started breaking to the upside, and this is actually the third point tap on a long-term liquidity pocket. So when you get free taps like this, guys, it is more likely to turn bullish. But if we go back to the imbalance, guys, we can actually see that although we will use an indicator, we can see that every other candle's wicks are meeting. So this candle by here, the following candle's lower wick didn't touch the upper wick on the candle before the last. Same with this candle by here, didn't meet that candle's wicks, and the same by here. So we're going to make it easier, as explained in our introduction video. We're going to put an indicator on. So just like magic, all these candles that are in balance turn black. We can see that the market is moving nice and efficiently, mitigating imbalance. We've got fresh imbalance here, guys. We know that the market is likely to come back, mitigate all imbalance, simply because there is a block of orders that have been placed here that have come into the market and caused this imbalance price. And the market will be drawn back to that like a magnet. Now, this doesn't happen always, especially if the market is inefficient, but it does happen a lot, guys, and it does happen to the extent that we use our trades in line with imbalance mitigation. So we're going to start playing price. We can see that the market has come back into this zone, and it's broken down. We've got fresh imbalance here. Now, this video, guys, is more just for you to see the nature of imbalance mitigation. So I just want you to observe the market going away, moving imbalanced, and then coming back to mitigate that imbalance before moving higher, and the same happens again. So by here, we have clear imbalance that is shown. So this is during the Asia session, guys, and the Asia session on the majority of major pairs other than Asia pairs, such as the dollar yen, it does move inefficiently, which means sometimes you won't actually get imbalance tap completely. So by here, we can actually see that there was imbalance and that got mitigated. Same by here, there was a bit of imbalance there that was left unmitigated due to inefficient price action. And especially at the start of the Asia session, guys, you'll know that it is actually less likely to fully mitigate. But we had an imbalance candle here. This mitigated straight away, and then this mitigated at a later point, and now we have fresh imbalance. The market comes back, mitigates the imbalance, comes back into the block of orders, which we'll normally put on the last counter trend candles, guys, whereas we will obviously cover in our order block video. But for now, all you need to know is the market is moving imbalanced away from the block of orders. Unfulfilled orders are being left. The market is coming back to fulfill them orders before continuing on order flow. So we have more imbalance shown. And I've marked the structure point here, guys, just because there's a lot of liquidity built up above here. And I'm going to show you a very nice example now of an entry using imbalance. So we can actually see already the market has started moving upwards, left imbalanced by here, that's come back down, mitigated, come up, imbalanced, unfulfilled orders left, and the market has simply come back down into this demand zone. Well, this is a large movement, guys. And obviously this, as crazy as it sounds, is the price action that we're going to be looking to get in on. So we draw our imbalance across here. We can also see, not imbalance, sorry, liquidity. We can actually see that there is a large amount of liquidity that the market has impulsively moved through and leaving a lot of imbalance on the way up. We can see that even this candle by here, we actually zoom in closely, guys, you can see that the candles don't meet. If you weren't using this indicator, this would be incredibly hard to spot. And the majority of SMC traders that we would be looking to get involved in this price action would likely be setting their orders by here, but not us. We're going to be utilizing all imbalance. We can see that there's no black candles by here. The black candle first started here. I won't go on to a lower time frame. We will leave that for a later video, but due to the length between these two candles wicks, if you actually went into a lower time frame, you'll actually know that there will be imbalance, or a much more visible amount of imbalance on a lower time frame. So we've got this swing marked out, guys. You'll know that just because there's been breaks to the downside, and we've had then structure breaks to the upside, and we've also now had some breakdowns of minor structure. Now, this is a minor swing, guys, for now. Once it does break through structure, it does become a major swing. So bear that in mind in future. I will upload more content now on the swing lessons, just so you're able to do this with ease. But just know, this setup, you don't need to understand the setup for now, guys. We will cover that in a later video on setups as well. I just want you to view the imbalance and what the market does to that imbalance. So again, we're going to draw our order block from the last attempt trend candle for all imbalance. I'm going to add that back by here. We're going to observe how the market reacts. Now, we can already see liquidity building up by here. I'm not going to cover all of this in depth in this lesson. We've got liquidity building up by here. That's going to get swept. It's going to form a new minor swing. Now that we've had a minor swing, we can actually draw longer term liquidity, which again, I'm going to cover all this in a future lesson, guys. So don't worry if you don't understand what I'm doing here. Just focus in on this imbalance point. We've got liquidity now building up to the downside, which we call sell side liquidity. And this has taken the form of equal lows. We call this inducement, guys. So the area of liquidity that's building up towards our entry point, we call inducement. Now, depending on how much there is, we'll actually look to avoid the market. Say, let me turn my magnet tool off. Say we had liquidity building like this, we would look to be avoiding the zone. As it's building up nicely above, we know that this demand zone is much stronger. And these the liquidity is simply inducement to allow the market to move back to our zone, and then it will target this longer term liquidity to move on its original order flow. Now, as with here, guys, we can see that imbalance was getting mitigated fairly quickly. And this will be because there's low volume in the market. This area by here, much higher volume. It's also mixed in with this liquidity by here, which increases the volume of the market. So it does take a lot longer for imbalance to be filled when you get these large swings. Price has moved into our zone. More liquidity has built up here, here, and here. You could even draw this dynamically, which will be covered in a later lesson. We know that the market is likely to target this. Now, there is a amount of liquidity that's been built up here, guys, but the market has actually had to sweep into this liquidity to get into our zone. If the order block was down here, we would be more wary of this long-term liquidity buildup. Again, I'm going to cover all of that in a future lesson, so don't worry about that. Just the imbalance that we're looking at. We're going to see how the market continues. Like so, we can see that there was imbalance by here, comes back, imbalance here, comes back, imbalance here. We're going to expect it to also continue on its previous path of order flow. Now, as I did mention, guys, at times of inefficiency, and this will happen when there is a large amount of imbalance in the market, imbalance won't actually get filled completely. So there is going to be times where if you're looking to get in a zone, for example, by here, and the market doesn't pull back enough, which will sometimes happen, that's simply because of market inefficiency, and that shouldn't worry you whatsoever. It actually means that you're just picking very strong zones, and sometimes the market doesn't pull back deep enough. You can actually see that it's come into this demand zone by here. Now, there are markets such as lower volume pairs like the Aussie dollar or the euro yen, for example, or even much more tropical exotic currencies. They are going to mitigate closer order blocks than the extreme order block, and that is due to them being more inefficient. The market has less liquidity, and therefore it can't pull back to the extreme swing supply and demand zones and fully mitigate all imbalance. But that is why we trade these high efficiency pairs such as the euro dollar, the dollar yen, and the US 30, guys, just because they do often pull back completely, like you can see by here. More liquidity building up to the upside, guys. And we've had a tap into this liquidity line, creating more liquidity. And as I mentioned by here, guys, once you get 3 taps on a long-term liquidity pocket, it is likely to break. And we get the break of this swing high, which is now a major swing high, might I add, and the order flow continues and the momentum continues.